Good morning. Welcome to Trading Hour. It's a Thursday morning. I'm Reema Tendulkar. With me, Sonal Bhutra. The Nifty holds above 25,000 in the green with a gain of about 1/3 of a percentage point. The Midcap index, though, has come off. In the morning, it opened with a gain of nearly 1%, and now the gain is about 0.5%. So some profit-booking moderation and momentum seen in the broader markets.
And that was something that was feared, right? Because yesterday we did see Midcaps doing well, but of course they fell from the highs as well. So not every dip is getting bought, but markets are coming off from the highs. If we talk about the sectoral movers, the consumption space, that continues to do well. So Nifty consumption, that index is up around 0.8%. The CPIC index is doing well. That one is up around 0.7% as well. So the defensives have come to the fore. Pharma index as well is doing well. That one is up 0.7%. So there are pockets which continue to do well, but as Reema pointed out, it has come off from the highs. For now, Nifty managing to be above that 25,000 mark. So we'll have to see whether that continues to sustain at those levels or we'll see some profit booking from those levels as well. But it's a very stock-specific market today. In fact, we have big moves coming on either of the sides, and Honasa Consumer is one of them. It is under pressure after a large block deal, but of course we'll talk about that in greater detail and what led to the selling and who are the sellers possibly in this particular block deal as well. So that is something that we'll get in Nimesh for a quick check as well. But specialty chemicals, that's the other space that is buzzing in trade. Remember, that particular sector did really well yesterday, but now we've gotten the exports data and that did not look very strong for the month of August. And remember, it has come in on the back of a strong number in the month of July as well. So if we talk about the numbers, number of reasons, Reema, this time around why exports were lower. The geopolitical tensions, we've been talking about higher freight costs, container issues, and that is something which impacted numbers this time. And Chinese dumping, that continues. That continues to be the big worry for the industry as well. So those are some of the reasons, and there was a single-digit decline on a quarter-on-quarter basis for the industry as well. If we talk about stock-specific news, let's start with Aarti Industries because this one has seen a sudden decline in exports. It did well the quarter gone by. The exports down 44% on a month-on-month basis. Quarter-to-date exports are down 28%, down 11% on a YY basis, and it was led by 38% sequential fall in one of their major products, which is MMA. And that's why Phillip Capital has gone ahead and cut their EBITDA estimates for FY25 and FY26. For Atal Limited, the story was not similar. They did well. Quarter-to-date, their exports are up 38% YOY. They are flat sequentially, came in at 121 crore rupees. And this was led by strong demand across products. If we talk about Phillip Capital, they have raised the target price to 8,500 versus 8,000 earlier. Vinity Organics, their quarter-to-date exports were up on a YY basis, flat sequentially, and this was driven by their major product, ATBS, which did really well. Newer products did well as well, butyl phenol and antioxidants. For SRF, it was quite stagnant. So exports were down 2% on a sequential basis, but they were down 10% on a YY basis. There was a recovery in the specialty chemicals demand, but the other segments did not do well. So chemicals have not seen the kind of recovery that the industry has been talking about. There is an expectation that second half will see full recovery, but there is no sign as such that we are seeing right now. And that's the reason some of these stocks are in focus today, Reema.
Okay, that's about the specialty chemical space. But let's talk about Honasa Consumer. Honasa Consumer is still down nearly 5%. There was a large block deal that took place in the morning. Nimesh had already warned us that, expect about 10-11% to, happen via a block deal. Nimesh, give us the details now, because the block has happened.
Yes, the block is done. 11% equity call change hands. We know that the private equity investors were sellers in today's block, including Sequoia Capital. Sequoia owns close to 23%, and the combined holding of all the private equity investors is close to 39%. They've sold 11% stake by block deal today. In terms of buyers, looks like it's a combination of both domestic as well as some FIs who've bought into today's block. The stock is under pressure because it happened at a discount and in the open window, so I'm guessing that there is a bit of a slippage as well in the block deal. Now, as I said, there is a 60-day lockup for the remaining stake, so Ps can't sell further, at least for the next 2 months. Again, if you look at the shareholding pattern, there was hardly any mutual fund participation or holding in Honasa before the block deal. So it looks like some mutual funds have loaded into Honasa in today's block. Valuation-wise, it's an expensive stock, so to speak, in terms of numbers. So maybe that's also adding to the pressure. But the fact that the Ps have sold 11%, they still own close to 25-26% further, and there will be supply overhang. That's the key reason why the stock is under pressure today.
Okay, all right. So that's a big cut on Honasa. Thank you so much, Nimesh, for bringing us all those details. So some of those stocks which were on our radar today. But we have to slip into a break. When we come back, we'll discuss what's buzzing in commodity space with Manisha Gupta. Stay tuned for that. Welcome back. You're still tuned into Trading Hour, where we spoke about equity markets. Let's shift focus to commodities space now. Manisha Gupta is joining in today, and today we are focusing on gold. Manisha, what's the update?
Well, yes, thank you for that, Sonal. We have seen the gold prices take a bit of a profit taking, and this is after the US inflation data yesterday, which has come in slightly higher than what the street was anticipating. But we still are holding above $2,500 an ounce. Yesterday's high has been $25.21. All-time high for gold has been $25.31. So not too far away from those kind of all-time highs. The gold prices clearly seem to be consolidating within this range, and this is because of ahead of the US Fed rating meeting in the next week, where there is now an 87% probability of a 25 basis point rate cut there. That pretty much seems to have been factored into the markets. It is really going to be about the guidance, the size, speed of rate cuts that you could be looking at going forward is what would impact the prices there. In the meanwhile, even as there are these corrections, but not too much, that is because the money managers, hedge funds have been holding on to their net long gold positions. The net long positions are the highest in last 4 years as we see it. Today is going to be all about the US PPI data that comes in today in the evening. That would give you further direction. In the meanwhile, all the reports and reiterations that we have seen from the international broking and banks, they have talked about higher gold prices going forward. Citi, for example, talks about $2,800 to $3,000 an ounce for gold in the next year. Bank of America talks about $3,000 as well. JP Morgan report that came in last week talks about $2,600 an ounce in the next week there. Almost Gold talks about $2,650 as well by the end of this year. So every report that you read is talking about much higher gold prices, and most of these banks and brokerages also are bullish until 2027 when it comes to gold.
Thank you very much for that. Let's invite the management of Monte Carlo Fashion on the show now. So earlier this month, in fact, on the 7th of September, the company announced its collaboration with Salesforce to drive personalized customer experiences. To discuss this and more, we have Sandeep Jain, Executive Director at Monte Carlo Fashions, joining in. Mr. Jain, morning. This is Rima here. Can you explain the scope of this partnership with Salesforce? Will you be paying a monthly rental sort of money, a SaaS revenue to Salesforce? What would that amount be? And what is the return that you expect? How will this play out? What's the ROI?
Good morning. Basically, we have been grappling with the issues of serving our customers both at our online and offline platform. And there have been, we were using multiple vendors for that. So Salesforce is one company which provides a platform where we can integrate our offline and online sales channel, as well as they help us in customer engagement and customer service and loyalty programs. So it's a bundled up everything, at one platform that will definitely save our cost as well. And also we expect to have good ROI on these marketing campaigns, which we'll do with the Salesforce.
Okay. So you already had an IT vendor doing all this. Now you've just decided to change your IT vendor to Salesforce. So there is no new offering that's coming.
Yeah, but the earlier vendor was not providing the customer engagement, AI and other services. So Salesforce is integrating all the future services also and the existing ones also.
What are the new offerings?
It's a customer engagement, customer analytics, and also marketing campaigns based on the customer analytics.
Okay. Mr. Jain, would there be any additional cost that you would have to incur now that you have changed the vendor here? And secondly, you spoke about marketing efforts getting improved. Generally, what is your ad spends as a percentage of sales? And with the festive season coming up, are we going to see some increase there as well?
See, the cost increase is not significant. It's a marginal one. And also, it will help us in improving our marketing campaigns also. Earlier, we were paying more in WhatsApp and other campaigns. So that will actually come down. So what was the second question? Can you please repeat it?
With the festive season coming up, what is the ad spends currently as a percentage of sales? And will we see an increase going forward, or are there any discounts that you are looking at in your products as well?
See, we have guided earlier also that we'll be maintaining around 3% of our sales as the advertising expense for this financial year. So that will remain same for the coming festive period also.
Okay. All right. Mr. Jain, I wanted to understand the export contribution that you have to your overall revenues. How much is it currently? Because different companies that we speak to have been talking about the issues of freight case, container availability being an issue. Is this something which is happening with the industry overall and with Monte Carlo as well? And if yes, do you think that in the longer run could impact margins?
Well, the shorter answer is that we don't have any exports. We are purely present in the domestic market. So we are not affected by container cost and so on.
Okay. But in the industry, if you've had a conversation, is that an issue that the industry is facing, your clients or the other vendors in general?
Definitely, there is a big issue in that. There have been increase in freight costs all around, I think, in many markets. So the exporters are actually facing, margin pressure because of increase in container cost and freight cost.
I believe this year you're targeting flat revenue growth, but the focus is on improving profitability. Where are we on that journey in terms of margins? What are current margins looking like? Where are you likely to end the year?
Fortunately, I think this quarter is going, more than our expectations. And there are three reasons for that. The first reason is that the monsoon have been very good, so that will boost the rural income and consumption. And secondly, we have seen that whenever there are good monsoon, it's followed by very good winters because of El Nino issues and all. And thirdly, this year the wedding season is much bigger as compared to last year, so that will boost the consumption. So good news is that we may revise our guidance in Q3. We may revise it upwards. Earlier we have guided for the flat revenues, and definitely the focus on the profitability will remain there.
So there's a possibility of increasing your guidance in quarter 3.
Yes, it's a possibility, and also we have a very strong trade show going on in the summers, which will definitely boost our double-digit growth in going forward in summers also.
So Q2 so far, you said it's turned out to be better than what you've anticipated. So are we looking at, single-digit kind of revenue growth quarter on quarter? Has it hit double digits so far, in the first half of Q2?
Well, the simple answer should be that it should be better than quarter on quarter and year on year also. But I can't quantify as of now because still we have 15 days left with this.
Okay, all right. And in 15 days, we do have the Shraddh season, but then from October, we have a lot of festivals which are starting up as well. So it's proper trends is something that we'll get to know then. Mr. Jain, thank you so much for joining in today and taking these questions and talking about the outlook, demand and the new tie-ups as well. That's the word coming in from Monte Carlo. We'll slip into a break. When we return, we'll discuss market technicals with Apur Sheth of Samco Securities and also discuss his top trading bets. Stay tuned.
Welcome back. Let's talk about the market technicals. Apurva Sheth from Samco Securities is now with us for a technical check on the market. Apurva, morning. Thank you very much for joining in. It's a good start, but it just appears the momentum is flagging a bit. What is your read for the day so far, and what would your stock calls be?
So thank you for having me on the show. So even we believe that the momentum is drying up in the markets, and September is a weak month for the markets. And on the September 18th, there's a Fed meet which everyone is expecting. So the market direction might be clear after that meet, and until then I believe that for Nifty 24,800 to 25,200 is the range that it will be trading in. So at least for a week we might see this range bound movement continue. For Bank Nifty as well, the resistance on the higher side is about 51,300 and 51,800. So even in Bank Nifty, we don't expect anything great to happen for the next 1 week. And on the stocks front, there are two picks. One is Anantraj Industries. The stock reported a very strong numbers in the last quarterly season with 50% sales growth and 80% PAT growth. Both sales and PAT were at lifetime highs in the last quarter, and the price is also breaking out of consolidation consolidation after almost a month today. So we believe that it is ready to move further up. The stop loss would be 600 and target would be 700 for Anantraj Industries. And another pick is Hikal Limited. The stock is showing strength after months of consolidation and a strong base build-up. So Hikal Limited could be a good pick from here on, and the target for the stock would be 450 with a stop loss at 378.
Okay, all right. Thank you, Apur, for joining in today. So those are some technical bets. But let's now look at some big numbers, big stocks today. Two stocks from the pharma space are in focus on the back of new US FDA observations. Ekta is here with the details. It's Zydus Life, and we have Granules as well in focus.
Well, yes, both these stocks are in focus. In a recent US FDA warning letter, I'll start with Zydus Life, which was issued on August of 29 to Zydus Life Sciences' Jarod facility. It was cited for multiple violations in that particular warning letter following an inspection which was conducted in April of 2024. Remember that this facility had already received an official action indicated status in July 2024 after that inspection which took place. Now, key violations which are pointed out in the warning letter include the failure to thoroughly investigate unexplained discrepancies, inadequate investigation into contamination in drug products, and multiple cross-contamination events over 3 months. Additionally, the US FDA has pointed out concerns on the inability to assess the root cause of glass particulate contamination which they saw. Now, poor aseptic techniques as well, and failing to follow written procedures. Meanwhile, the US FDA separately has issued 6 observations to Granules in a Gagilapur facility. This is after an inspection which took place in late August 2024, pointing to concerns such as unclean equipment, inadequate reviews of discrepancies, and repeated quality control issues. The US FDA has also pointed out to a repeat observation from the company's Jan 2023 inspection. In total, there were 6 observations, but I went through the Form 483, and the first observation itself ran over 15 pages. So it's probably indicative of the fact that Granules is probably going to face a long road of remediation, or maybe a tougher road of remediation for this particular facility.
Okay, all right. Thank you so much for that, Ekta. But even Aurobindo Pharma, it is up in trade today. What's happening there?
Well, yes, Aurobindo is in focus because there's a piece of news which is coming on GSK. GSK is set to close its cephalosporin manufacturing facility in the UK by June of 2025. It basically is an antibiotic, cephalosporin. And the reason they are closing it in June 2025 is after they are fulfilling their contract that they have with pharma company Sandoz. Now, analysts predict that this move could probably pressure the global cephalosporin supplies and possibly even drive up prices. Now, Aurobindo has capacities in cephalosporin manufacturing, which then could be well positioned to address any potential shortages, according to analysts. Now, in related news, remember that Aurobindo recently received US FDA approval for lidocaine hydrochloride injection from its new injectable facility under Eugia, which is situated in Andhra Pradesh. This, in fact, could help them diversify supplies from Eugia Unit 3, which is under the regulatory scanner. They received a warning letter on that particular plant recently, and hence the street is probably optimistic on that front as well.
Thank you very much for that. That's the pharma update for the day. We'll slip into a break. We'll come back and discuss market fundamentals. We'll invite Nirav Asher from Latin Manharlal Group.
Welcome back. You're still tuned into Trading Hour, and markets have come off sharply from the highs, still managing to be in the green, but Nifty is below the 25,000 mark right now at 24,976. So important to track those levels because it has been very range bound in the last couple of trading sessions as well. But let's get in some market fundamentals as well. Nirav Asher from Latin Manharlal Group is joining us now to discuss that. Nirav, good morning. Thank you so much for joining in. Well, what is the market mood right now? Because we do see those higher levels, but we have been coming off from there. What is the current valuation picture looking like, and some of the sectors that you are bullish on now?
Yeah, good morning and thank you for having me on your show. Starting off with the markets, I think the markets have been under some amount of pressure. Yesterday, particularly, we've seen the China-related data has unsettled the markets. We've seen a lot of vulnerability of the Chinese data. We've heard news about the slowdown in the Chinese real estate market. Then this has spread over to the metals, then to the oil and gas. And yesterday, the BMW has also cut their guidance, citing a muted Chinese demand. So I think a lot of areas where this news is spreading around, and the fears of a global slowdown are looking quite authentic. And we have the Brent crude, which has gone below the $75 mark, and now it's even gone below the $70 a mark, just to recover a bit. But I think from this perspective, the markets have been quite nervous. In yesterday's trade post-afternoon session, we did see correction in the large cap stocks like Reliance, L&T, Tata Motors, SBI, Mahindra & Mahindra. So I think at this point of time, the saving grace for the market is the golden troika, that is the FMCG sector, the pharma and IT. These sectors have shown a lot of resilience, and at this point of time also they continue to do quite well in the market, especially the pharma space has been doing quite well. IT has been holding out quite well in the market.
So FMCG, pharma and IT. So Nirav, you're positioning your portfolio for a global recession. Is that why you've got a completely defensive tilt? And say you've got 100 rupees of a portfolio, how much of it would be in these three sectors?
I think at this point of time, the rest of the sectors are looking stretched in terms of valuations. I think auto is also reeling under some amount of pressure. Today, we did get some positive news, but I think the rally has been sold into, and banks have not been participating in the rally. So I think it would be fair to give an allocation of around 20% to each of the three sectors which we just spoke about.
Nirav, you also have some of the stocks that you like from the large cap space. You know, large caps did see an improvement in inflows in the month of August as well, as per the mutual fund data. Take us through that. L&T is one of it. The big capex cycle. We've been talking about a lot of changes coming by in the sector as well. What is it that you like about L&T?
As far as Larsen & Toubro is concerned, I think they have been a big beneficiary of overseas orders. They have around 40% of their order book, which comes in from the international orders. And Middle East accounts for a big chunk of these orders. One important factor about the overseas orders is that the working capital terms in these orders are quite favorable as compared to the domestic peers. So going forward, as the execution picks up, I think working capital issue is a matter which has to be handled very sensitively by the infrastructure companies. So that is one positive. At the same time, L&T is now focusing on being asset light. So that is another positive for the company. The third important thing is that they have a very strong order book even in the domestic markets. And plus the other areas where L&T has been concentrating, especially the IT business, the real estate business, those have been doing quite well. And apart from this, of course, the financing business, L&T Finance has also been doing quite well. So I think all these things augur quite well for L&T. There is a lot of hidden embedded value which is there, which can be unlocked going forward.
Nirav, one would assume that L&T performs poorly when crude prices decline, given their dependence on Middle East. The wealth of Middle East comes down with the decline in crude prices. But you're saying that it's actually a positive for an L&T. Historically,
yeah. So yesterday we did see some correction. We did see some pressure on L&T. But L&T has been very flexible as far as bagging orders is concerned. Whenever the crude oil is doing quite well, they manage to procure a lot of orders from the Middle East region. And in other times when the domestic market is doing quite well, they do participate well in the domestic market as well. So if one were to look at the overall performance of the infrastructure sector, L&T has actually reduced their guidance also. They have reduced the guidance for the next year. But this is taking into account the fact that the infrastructure business is essentially a low margin business. So that is a reality check for this particular business. And that is why they are concentrating on other areas like information technology or the real estate business and the financing business, etc. So I think these businesses will add more value to L&T going forward.
Okay. All right, Nirav, thank you so much for joining in today with your market fundamentals and the outlook going forward as well. That's the word coming in on markets, but it's time for a short break. On the other side, we'll be joined by Karthik Padmanabhan of Zenove to discuss India's global capability centers landscape.
Welcome back. Now, India is called the GCC capital of the world. Now, GCC stands for Global Capability Centers. Now, according to IT industry body NASSCOM and the consulting firm Zenove, the GCC market in India is expected to hit a size of nearly $100 billion by 2030, and currently it's about $65 billion. Also, the number of GCCs who set up shop in India currently stands at about 1,700, and this number can rise to 2,100, 2,200 by 2030. Now, you would ask, why is this relevant to India's? Well, if GCC expansion continues in India at a rapid pace, it also poses a risk of insourcing to Indian IT companies, because work which would have otherwise gone to IT service vendors are now going to be done by the GCCs. And GCCs are now doing strategic work. They've become large technological outposts for MNC companies. GCC expansion also affects the talent market in India, because what we've learned is that most of these GCCs pay higher salaries. There is one report, I think by Team Lease Digital, where they're saying that they're paying about 12 to 20% higher compared to the Indian service vendors. So therefore, it puts that competitive pressure on the industry to recruit top talent. There will be pressure on margins as well. But to talk more about how GCC market is evolving in India, we have with us Karthik Padmanabhan, the managing partner of Zenove, joining in. Karthik, thank you very much for joining in. This is Rima here. So first, if you could just lay out the GCC landscape in India right now.
Thank you, and thank you for having me. And you gave a great introduction into how the GCC landscape is really exploding within the India ecosystem right now. We have just launched the Zenove NASSCOM GCC Landscape 2024 report, and it really tells a story of a robust and a mature GCC industry, which continues to take great strides in enabling global organizations. Sometimes you look at products for the world, which are actually built in India. We have about 1,700 GCCs in India. It's home to 1.9 million professionals. I think you called it as the GCC capital of the world, which is absolutely true. It has the largest base. It has 17% of the global technology capability centers across the world based in India, which is approximately 23% of the global software engineering talent is also based in India. Further, if you really look at it, 70% of the Fortune 500 companies, think about it, 70% of the Fortune 500 companies will be expanding their presence in India by 2030, which is a significant number when you really go about it. Right, a revenue standpoint, you hit it absolutely correct. We estimate the GCC revenue to be close to 65 billion, potentially going to about 100 to 110 billion in the next 5 years. We don't see this slowing down at all, right? We see this, if anything, accelerating even further. We see expected to be about 2,200 GCCs by 2030, double the number of units. We're just talking about GCCs about 2,200. But if you look at most of the centers today have a first center, they're opening up a second center or a third center. So we almost expect about 4,400 to 4,500 centers across India by 2030, and a headcount of over close to 2.8 billion to 3 billion people, right? Which is 3 million people, which is significantly high when we look at the overall number of tech professionals and GBS professionals right now, right? So that's the kind of landscape that we were talking about over here, significantly expanding in the GCC side.
Okay, Karthik, good to have you on the show. So you said those numbers, they seem to be suggesting that there's going to be a big growth, and you also said there's going to be no slowdown in the growth that we are seeing in GCC. What does it mean for the other sectors? Currently, GCCs are concentrated in the BFSI space. So do you think there is a risk of insourcing in the BFSI segment? And are there any other sectors where there is a possible risk like that?
So let's actually talk about the maturity of some of these centers. Some of these centers, so BFSI sector has been in this area for quite a long time. So if you really look at some of the centers that were actually set up, either JP Morgan, for example, that set up long ago, Citibank set up long ago, Standard Chartered set it up about 20 years ago, for example, right? These have all become mature centers, right? HSBC operations, there are about 42,000 people who are here across technology and operations. The same thing has expanded across all centers. We are seeing a significant uptake in both healthcare and life sciences. Healthcare and life sciences has become a very mature GCC industry today. There are a number of large-scale, both healthcare and pharmaceutical companies who are set up there, both technology, R&D, and IT services, operation services, clinical research, all of that being done over here. Retail, again, and consumer goods, for example. So companies like, let's say, a Walmart or a Tesco, Pepsi, Nike, they have been here for a long time and they're continuing to mature. They're also looking to build core COE capabilities. So artificial intelligence, machine learning kind of work is also coming in. But we should also then acknowledge the work that the technology centers have set up. So your Microsoft, Google's, Amazon, Adobe's, they are the ones who really push the technology maturity up the curve. So today, when you walk into a GCC, you're likely to see cutting edge work being done. You're likely to see extremely technology work. But back to your question, does it impact the service sector, your IT services background? I actually come from an IT services background as well. So I've come in from an organization which did IT services into the GCC sector. I'm able to see both, right? And today, it is a mark of maturity of the sector that both IT services and GCCs are able to coexist, right? They are able to coexist, work together. IT services companies are able to provide a flexibility in terms of workforce, talent, ability to ramp up quickly, ability to harness talent faster. So that is definitely ability for them to work together. Another big angle from the IT services side is the fact that they work across sectors. So lessons that are learned from, let's say, a manufacturing, logistics, retail, can always be replicated into a banking sector or into an insurance sector, for example, especially when it comes to consumer behavior, consumer goods, and things like that. So IT services sector are able to cross-pollinate learning, and that cross-pollination of learning then can apply into a GCC. So I do see that this sector, both, in fact, in a way, there's a symbiotic relationship with both spurring each other on, and I do believe there's a space for both of them.
Just a quick word, we are running out of time, Karthik. What about the salaries paid by GCCs versus the other IT service vendors? Have you done any analysis on this? How much higher are we talking about?
And your numbers were spot on, right? You said about 12 to 20%. Our numbers indicate roughly the same. GCCs are able to pay 20% upwards, right? So anywhere between 18 to 22% higher compensation when compared to an IT services sector. And therefore, they're also able to attract better talent to a degree, right? So you're looking at, let's say, niche talent, they're able to attract that better. Now, GCCs also have a pyramid structure, which is probably more closer to the middle sector. They are having more experienced people, architects, more senior staff within them because they're able to attract it. An IT services sector would typically take in from the bottom, have a large intake of 0 to 2 years experience and groom them all the way. So a different philosophy in terms of how talent grooming actually happens, but the GCCs are indeed able to attract better talent by paying higher compensation.
Okay, all right. So higher compensation coming in from GCCs. We'll have to see how salaries pan out in the IT space going forward. Thank you so much, Karthik, for joining in today with your take on what's happening with GCCs, something that is expanding the market, something we'll be watching out for as well. Time for a short break now. When we return, we'll get you excerpts from the conversation we had with Sunita Reddy, Managing Director of Apollo Hospitals, on the sidelines of the IMA 51st National Management Convention. Stay tuned for that.
Welcome back. The Nifty is now dipped below the 2500 handle now. At one point of time when we opened, the Nifty was up close to about more than 100 points, comfortably more than 100 points. So some of those gains have come off. So, as we were highlighting, the momentum on up days has been a bit on the slower side. So some stocks where some profit booking has, set in. You've got, Divi's Laboratory, which is, I think, slipped a bit from the top of the trading session. So that's, I think, down close to about 0.5%. You've got Divi's Laboratory slightly under pressure. Some of the IT names like TCS dipped into the red. LTI Mindtree has given up all its gains. HCL Tech too has flattened out. So IT too is, in the morning it had opened up in the green, but now it's on the flatter side. But let's get you an important corporate conversation. Now, this is from Apollo Hospitals, where the company is expecting a growth of 14 to 15% over the next 12 months. This is the word from Sunita Reddy, Managing Director of Apollo Hospitals, speaking to my colleague Lata Venkatesh on the sidelines of the IMA 51st National Management Convention. She also spoke about the company's expansion plans, foray into the insurance sector. Listen in, and after this short commercial break, we'll be back with Halftime Report.
More than scared, a sense of preparedness is always good. So bringing back the protocols that we learned during COVID-19, which is, making sure that when you hear more cases, wear the masks, keep washing your hands. People with some symptoms should get isolated and tested. These are necessary protocols, and I think even with this viral fevers going on, it would be good if people followed these protocols. And monkeypox, children are more vulnerable. So for that sake, I think we should be extra cautious.
But it doesn't look like it's going to be something of a national problem.
Right now, it doesn't look like it, but I think learning from the lessons of the past, we should be prepared. Let's never underestimate. It's better to be over-prepared than be surprised or shocked.
No, fair point. Okay, now let me strike a note of business. This is a corporate radar show. You announced foray into insurance. So can you tell us, are you planning to launch full-fledged into insurance? What's the plan?
So it's 24/7 Apollo Health Co., which will have an insurance product. They've tied up with Bupa. It's more of being able to sell Bupa products online. And this is really good because what 24/7 is really, it's a holistic view of healthcare services and the ability to consume healthcare at every level. And what this will do is to enable people to pay for the healthcare that they purchase, whether it's inpatient, a diagnostic, and hopefully pharmacy. So I would say that it's a valuable addition to the offerings that 24/7 is doing.
I think when you last reported the quarter, the average revenue per bed, per occupied bed, it slowed to a 2% growth. I mean, compared to a very good fourth quarter, it seemed slower. How does it look current quarter? How does next quarter look?
I think the most important thing here is that I wouldn't look at it as a slowdown. If you looked at our volumes grew by a very healthy 12% and revenues by 15%. So what this RPOB represents is really the fact that, that more people had access to corporate hospitals like Apollo. More people who also came for secondary care surgeries. And that's a good thing, because if you look at the average realization per patient, for 75% of our patients, it's 1.5 lakhs, which makes it very affordable and keeping margins of 23.6%. So, but going forward, you will see an improvement in RPOB coming from tariff and case mix, about a 7% improvement.
Actually, what is the plan in terms of greenfield and brownfield for this year and next? For this year and next for hospitals?
Apollo.
Yeah,
yes.
Apollo.
So in terms of greenfield and brownfield, we have a combination coming up. So in 2025-26, you will see 4 hospitals. The first will be Gurgaon, which was a brownfield. We acquired a hospital, will be ready for opening. We'll have 400 beds. You will see Pune, where we acquired a 250-bed hospital. We will open 250 beds and it will move into 400 2 years later. You will also see Kolkata, where we've acquired a hospital in Sonapur, which again 250 beds, and I think one in Hyderabad, which is in Gachibowli.
Okay.
So 300 beds. And let me say that, I have to put a disclaimer there that while I've mentioned total number of beds being over 2,000, we will open 50% of the bed capacity in 25-26, and then the next half in 26-27.
Okay. So it'll be more of coming from greenfield then in the coming years?
These are, yeah. So there are 3 greenfield projects that we've identified moving into 27-28 that will open out. So we'll be adding a hospital every year till 2030.
That's actually very good to hear from a citizen or a consumer angle.
Yes.
But for the investor, they would think that more greenfield will mean probably a reduction in margins in the year of operation. You don't think so? You think margins
no,
can?
So these are brownfield, and 2 things to do, that I should talk about. One is that our EBITDA and cash flow is very strong. So, the 100 crores of loss coming from new hospitals is not going to impact margins significantly. And it's happening in a calibrated manner where free cash flow growth and EBITDA is very, very strong. The second is some of these are in locations where we already have a very strong presence. So break even from year 1 is something that you can expect to see.
Okay, so give me a number then in terms of top line and margins for the next 12 months.
I think 14-15% growth in top line for sure. And to make sure that on a larger base this happens to 2030, that is real growth, a CAGR of 15 moving into it. And that's what we're doing with these investments. In terms of EBITDA, I think mature is at 27%. We took on some extra costs last quarter, which made it 23.6. But I think 24-25 is a stable margin that we can expect.
That's very good to hear. That's very good to hear. Business and pleasure, that is. Thank you very much.